For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future.
It sure is. Welcome back to the program. This is Managing Your Financial Future, and I am Johnny Dean, your podcast host. Happy to have everybody here once again, and especially happy to have my good friend, longtime friend, Professor Rick Plum, certified financial planner, professional, accredited wealth management advisor, here to talk about the why the first 5 years of retirement are the most dangerous. Now, I just said 5 years, Rick Plum, and I'm really just speaking mainly financially. I'm not talking about you could, go skydiving and forget the parachute kind of thing.
Well, you're still young enough you can do those things.
Well, and really, when we talk about retiring, we generally refer to people who are retiring, right around age 65-ish, maybe between age 60 and 65. I would say that the financial danger, if you retire at, say, age 88 for whatever reason, and you still have all of your money because you've been saving all that time, you're probably less affected by what we're going to be talking about. But most people don't do that. Why are the first 5 years, maybe the first 5 to 7 years, the most dangerous? Well, let me give you a stat, and you know this one, Rick, because you've seen this many times. But let's go back to 2022, and we remember the stocks took quite a dive. The S&P 500 index had a net total return of roughly negative 18%, a little bit more. And that's including dividends. If you take dividends out, ex-dividend.
And that was for the whole year. It was down more than that in the middle of the year.
Well, that's true. Yeah. It recovered somewhat, not a lot, but it recovered somewhat over the last, I think, quarter and a half. But ex-dividend, it was down for the year about 19.5%. Now, I don't want to say the flip side, because it wasn't a flip side. It was the other part of this was in 2022, the Bloomberg U.S. Aggregate Bond Index, which is, as I understand it, the most widely used benchmark for the U.S. bond market. I looked that up, had a total return of about negative 13%. So stocks and bonds were both down. Now, why do we normally have a stock and bond portfolio? Rick, let's just explain that for about 30 seconds, please.
Well, historically speaking, when stocks are down, bonds are up, and they kind of negate each other's negativity, although typically stocks have a much higher volatility exposure than bonds do. But the idea is that the income from the bonds and the movement of the bonds typically counteract a little bit of the negativity movement in the stock market. In 2022, they both went down, and so it didn't work. It didn't quite work right.
It didn't work, and that's fairly rare. It's uncommon for that to happen. Would you say?
It's becoming more common, but it's still not the way it's supposed to work, shall we say?
Yeah, it's supposed to. They're supposed to balance each other out. So I guess it's safe to say that sort of that thing in the market that happened that year was unexpected. So why am I bringing that up? Well, what would have happened? And we kind of talked about this. We did, I think, back in March, something like that. So it's been a little while, but I'm going to take a little bit different tack on this. But what happened then if you retired at the end of 2021, when at the time I think the S&P was at a high or pretty close to its all-time high, and things were looking pretty good. You had low interest rates, if you wanted to borrow money, and your stocks were doing pretty well. They had recovered from whatever happened in 2020. So this is where people probably felt it the most. Rick, why do losses in your portfolio, early losses, hurt more than losses later? Let's say, why would losses when you're age 63, 64, 65 hurt you more than if you're age 85, 86, 87?
Well, it's not necessarily how old you are. It's in the distribution phase, how many years into the distribution you are. And so if I have a loss in the first or second year of my distribution, I start off with my proverbial $1 million. take my 40,000 out, and then the portfolio goes down 10%, my $960,000 went down by $96,000. So I'm down under the $880,000 mark, give or take. It takes a lot to recover back up and get me back to that $1 million mark. I've got quite a ways to climb out of it. I've got to do a 14+% rate of return just to get back to even, let alone to back to where I was supposed to be in my theoretical mind of earning, X amount of dollars. On the other hand, if I've had a couple of good years behind me, I started with my $1 million and I took my 4% out, but I made 10%. Now I'm up to, $1,060,000. I'm ahead of the curve. And when I lose money, it brings me back down to the curve of where I expected to be. And so losses early, and it's, one of those math issues. It takes a lot more to earn it back than the loss. So a loss of 25% requires a 33% increase to get back to even. That's just back to even, let alone where we wanted to be with some growth on the portfolio. So once we've built up some tolerance, if we have some positive years going forward for 6, 8, 10 years, we have some wiggle room. If we have losses in the early periods, we don't have that wiggle room, and it's much harder to recover. And that's why that sequence of returns, do we have a series of positive years? Do we have a series of mixed years? And typically mixed is where we have a problem, because it's very hard if we are using the market to provide our income, cash flow, I should say, the stock market, bond market to provide the cash flow, and it loses money. It's very hard to recover from that because, for one thing, the money that I took out of it when the market was down can't recover. It's gone. I don't have the time horizon for recovery because I've already spent the darn stuff. And so losses in the early part of my distribution phase, and whether it's paying for college, whether it's retirement, whatever my distribution phase is, losses in the early part of it have a much more dramatic effect on the viability than losses in year 12, 13, 14, where I'm potentially ahead of the curve.
Yeah, and what you're saying is when you sell these shares, especially shares that are down because you needed the money to live off of, and you sold them at a loss, those shares are gone forever. So, even if the market recovers as it may, the portfolio cannot fully participate in that rebound unless you got a ton of cash on the sidelines to somehow buy back in. But then you're getting into the whole market timing thing. We've done this before where we kind of showed there's a chart, and I can't show it on the podcast, obviously, but we've done this where you've taken, I think it's a 15 or 20 year period of time. I can't remember. It's off the top of my head. But we have this in our retirement guide, which you can download at luciacap.com. But it shows, I think it's a 15 or 20 year period of time. It's
15.
Okay, 15 years. And
we're using the exact same returns over the 15-year period of time, except for in reverse order. Mm-hmm. So in one 15-year time period, the bad years, so to speak, happen in the last 5 years. But I do have the retirement planning guide right in front of me.
Oh, good. Okay. Well, can we run that down just a little bit here?
And so the returns were 8%, 11, 18, 14, 12, 9, 11, 9, 7, 5. And then in years 11 through 15, then we've got a -4, -8, -15, -6, -5. All told, in a buy and hold situation, you've got a 4% overall rate of return. The early years were offset by the later years. Now, the other one did the exact opposite. We started with -5, -6, -15, -8, -4. And then we got the 5, 7, 9, 11, 9, 12, 14, 18, 11, 8% returns after that. Again, on a buy and hold strategy, it came out to a 4% return. Mm-hmm. But there's a big, big difference when you are taking money out of the portfolio. There's a big difference also when you're adding money to the portfolio. So depending upon where you are in your financial life, you either want the one with the negative returns at the beginning, if you're accumulating money over the next 15 years, or you want to avoid those early years if you're distributing money.
If you're making the wrong distribution, yes. Well, and you've said this before, if you're in your 20s, let's say, and you just start investing in your 401k and the market takes a big dive of 20-30%, and you're just continually investing in your 401k, those early negative returns during your accumulation phase actually help you because you're buying shares at a discount as they go down, presumably. And then when they potentially recover, as they often do, you have more shares, and that actually helps you a little bit later on. And what you're saying is the reverse is true if you're taking money out of that portfolio. It's really interesting how that works. Now, on that 15-year scale that you just mentioned, as you said, the aggregate result over those 15 years was exactly the same, 4%. But you had good returns early on one side, and you had bad returns early on the other side.
Exactly. And it basically has a problem. So if you were in the portfolio that had the $1 million, and let's say you were taking 5% out, $50,000 a year, and you earned 4%, an aggregate 4%, but it's not actually an aggregate 4% because your early returns helped you out a little bit. And after 15 years, you ended up with a little over $1 million, just shy of $1,020,000. Started with $1 million. You earned an average if it were buy and hold, but average only matters when it's a buy and hold. It doesn't have the same return when you're taking money out. If in that first one where it was positive for the first 10 years, negative for 5 years, you had a little over $1,020,000 left over, you actually earned about a 5% rate of return.
Not bad.
You turned a 4% rate of return into a 5% rate of return, even when taking money out of it, because you had great experience in the beginning years. But the problem is on the other side. If you had the negative returns first, you started with $1 million, stick to the same $50,000 out a year. After 15 years, you ended up with a little under $320,000.
And this is starting with $1 million, and that's just with some lousy years for the first 5 of retirement, right?
And that's a problem. So earning that proverbial 4% turned into an actual, when you do the reverse dollar cost averaging, turned it into a 1% actual rate of return, annualized rate of return going forward. So that's why sequence, when the negativity happens, is very important to a retirement plan, to a distribution plan. So it's one of those things that you got to control that. And so, wait a minute, how can I control what's going to happen in the economic markets over the next 5 to 6, 7, 8 years? I can't. You can't. Nobody we know can control that. So we have to find a way to protect against that and not let that hurt us. And that's the whole idea when it comes to distribution planning. And that's the problem, because we don't want to give up the potential to get those great rates of return, but we also don't want what the negative rates of return can do to us if we're withdrawing money from the portfolio. So that's why we need to have the portfolio, but not rely on it in the short run.
Yeah. Well, and really, this is obviously we're leading into buckets, but this problem has been going on for a long, long time. And, with the advent of the whole, we talked about this a few weeks ago, the whole modern portfolio theory, and the balancing and the 60-40, 70-30, whatever it happens to be, it kind of advocated, or at least defaulted to, the kind of withdrawal strategy that doesn't really work.
And we've been hearing about modern portfolio theory for the last 70 plus years. Diversification is the key to your long-term return. There's some validity to it, but not in the same way that we're using it, only in an accumulation strategy, not in a distribution strategy. We've been told the 4% rule, which has been revived up by Dr. Benjamin now to 4.7 or so, but he's still using a systematic withdrawal from a diversified, balanced portfolio. They're not addressing the key component to the negativity of the market. Let's not play the market's game. Where we cannot take advantage of the market, let's not use the market unless we can use it to our advantage.
Now, why is it? I mean, these stats speak for themselves. Everybody has access to these kinds of things. Why would anybody decide to take a systematic withdrawal out of a portfolio when they don't know when the downturn is coming? I think we know it is coming. It always does.
There's always a possibility of one.
Yeah, and there always has been one somewhere at some point. We just don't know when. Why would anybody advocate a systematic withdrawal? In other words, just cut off, your 4% off of your stocks and bonds or whatever you happen to do, rebalance up back to your 60-40. Why would anybody ever advocate that?
Well, I think there's a couple of problems that come out of this in that the people that are talking about this, you, me, and some others like us, our voices are nowhere near as loud as the people pushing the 4% rule, modern portfolio theory, the things that have been around forever, the things that have been drilled into the everybody's head. If they read any of the financial networks, any of the financial magazines, they've been talking about this systematic withdrawal, and it's been drilled into us for so long that it has become fact in a lot of people's minds, and they don't look at it any other way. And the other side of it is to look at it in a different way, like we're looking at it here, requires additional thought process. It requires a little bit of work. People don't necessarily understand money. They don't understand rates of return. I've said it many times. Most people don't like math. You put a dollar sign in front of it, and they get emotional about that number and that math. And emotions tend to screw us up when we talk about investing. And so we don't look deeper into it. And frankly, a lot of people just want it to be easy. They want to hear that I can do this, set it, forget it, and be done with it and not have to worry about it. When the reality is it doesn't take a lot of work, but it takes some work, more than just putting your money into a target date fund.
Well, and we've seen the charts too, where if you have a good sequence of return, you may have a fabulous 10, 11, 12, 13 years. I mean, we've had periods of time where that has happened, and you just happen to retire at the right time. Using that systematic withdrawal
it can work really well at times.
Strategy can actually, yes, we've seen the charts where if it actually beats from a rate of return standpoint, it can beat a bucket strategy.
Well, of course, if the markets and if all the planets align, the stars align, and you have nothing but positive sequence of returns going forward, by definition, you're going to do better with a sequence of return with a balanced portfolio than you are with one that's a little bit more conservative. On the other hand, you don't know what you're going into. So you're playing the dumb luck, and maybe you're the type of person that's always, been lucky. Everything, you always find that, the dollar on the street, everything has been lucky for you your entire life. And so you're just going to go with that flow, and maybe you'll continue to be lucky. Or maybe you're more like the rest of us that deal with Murphy's Law. And we know that if there's a bad time to occur, it's going to occur right after I retire. And I've got to be able to survive that.
Well, we've talked about how a plan that has to have every single thing go right in it is not a good strategy. It's not a good plan. I think about it if I had a complicated travel plan where I'm going around the world, but I gotta have good weather for the first 3 or 4 days because I can't miss this flight, and we're going to catch a boat going this way, and there can't be any delays. And the more complicated it is, and the longer it is, if I'm taking a 3-month cruise or trip around the world, if I have to have every single thing go right in order for me to get back safely, that's not a good plan. And the way I look at that is everything has to go right on these systematic withdrawal type strategies. And that's just nothing more than gambling, in my opinion. And this is what makes the early rates of return, the first 5 to 6, 7 years of your retirement, dangerous if you don't have the right type of withdrawal strategy.
It can get a little scary out there because I have never met anybody that can predict the future, and I haven't actually ever met that lucky person that I was talking about before. And Murphy's Law rears its ugly head quite often, and it's just a matter of if you're relying on only good outcomes, I don't know what kind of life you've led because you haven't been a normal life.
Well, it would seem to me if you've had nothing but good outcomes, you're due for a balance shift here, and you may be even taking a little bit more of a risk. So we've, of course, talked many times about the bucket strategy. And if you would, Professor, because I know we have some new listeners and even some of the older, longer-time listeners who have been with us for a really long time, could use maybe a little bit of a reminder as to how a bucket strategy deals with this and potentially avoids these problems, especially in the first 5 years of retirement.
Well, I remember giving a seminar years ago, and the person, we were talking about it, and the person in the front row asked, what if I have enough money in cash to meet my distribution for my expected cash flow needs for the next 3 years? I said, well, that's a good start. That's a real good start. But if we go back to 2007 to 2009, did that let your portfolio recover all the way by 3 years? In many cases, it only got you close to the bottom. Now, it did get you a little past the bottom, and it had started recovering, but it was nowhere near where it was back at the peak when you started this. 2000, if you started this in 1999 and you had 3 years worth of cash, it got you to 2000, 2001, 2002. It got you through 2002. But the market was at a pretty low point in 2002 compared to the end of 99, beginning of 2000. Having 2 years worth of cash just isn't enough to avoid. I said earlier, we don't want to play the volatility game in the short run. We like the volatility, the positive volatility that we can get out of the market for the long run. We don't like it for the short run. The decision then becomes, well, what is short? And when it comes to the market, short is 5-6 years. You cannot count on the market to be positive and to have recovered from a downturn in 4 or 5 years. Now, most of the time, it recovers after 4 or 5 years. But there have been some longer-term ones, most notably 2000 to 2009, where after 10 years, it had just recovered. And so if you only had 2 years, 3 years, 4 years worth of cash, well, you're still reverse dollar cost averaging. So the only way to avoid the impact of the negative sequence of returns is to not play the game. Kind of like at the end of the movie War Games with Matthew Broderick, when the computer is playing, tic-tac-toe or whatever it was, and finally came out, the only winning move is to not play.
Yes.
Well, that's when it comes to the volatility of the market. If I'm going to spend money in the early years, the only way to avoid the potential of losing money on some of those distributions is to not play the volatility game. And so that's why we create bucket number one. Bucket number one is generally put together so that it can distribute principal and interest for the cash flow that we need over the next 6 to 7 years. So let's just ignoring rates of return. If I need $50,000 a year for the next 7 years, I need $350,000 in bucket number one. Mm-hmm. That will allow me to distribute $50,000 a year for 7 years and using principal and interest. But that now we're assuming you have more than just $350,000 too. I remember John, you'll remember this too, John. Years ago, we took a call on the radio. The guy said, I need $30,000 a year and I have $300,000 and I need it to last forever.
Yeah.
Well, that's a 10% return each and every year, never having a downturn. It's unlikely you're going to be able to do that and last more than maybe 12 years, 12, 13 years. It just, the negativity of returns, and it happens even in positive years. At some point during the year, there was a negative time. So you're almost always selling something at a loss at some point during the year. So we want bucket number one to withstand the majority of downturns and be able to recover. But then we also have some money in bucket number two. Now, bucket number two is not the rest of your portfolio. It is a portion of your portfolio to refill bucket number one for another 6, 7 years, 8 years, so that you can get out to the worst time periods in the stock market of 15 years. We've never had a 15-year period of time where the stock market did not produce positive plus inflation rates of return. So bucket number two is that midterm, the mid buffer. Now, bucket number two, it does not have to be as liquid. I don't need to take any distributions from it for the next 6, 7 years. It does not have to be as secure because I can accept a little volatility. I just don't want the whole volatility of the market. So maybe I take a little volatility. You look at a balanced portfolio. This is actually where a balanced portfolio fits pretty well. If you look at a balanced portfolio at the beginning of 2007 to 2009, they were down 25% on average in that 2008-9 downturn. But by 7 years, by 2014, they had recovered and made a 3 or 4 or 5% rate of return. And so they'd made their positive return. We had given that asset class time to recover. It wasn't taking the full risk of the market. And that buys us time for the rest of the portfolio to be put in the stock market. And even if Murphy's Law raises its ugly head and it goes down 50% in the next year to 2 years, now you got 12 years for it to recover. If you had invested in 2007 and you watched the portfolio go down by 50% almost in 2008-9, the great financial reset, and you did not sell, what's 15 years later from 2007? 2022? You had a pretty dadgum nice rate of return. By 2020, if you were an investor starting in 2007, watched it go down and watched it recover to 2022, you did really, really freaking well. And it also just happens that the end of 2022 was the top of that market, and then it went down, or even that was even after the recovery of 2022.
Yeah.
So if 2022 wasn't even the greatest of years, and you still had a good rate of return. Well, it would have been better to get out in 2021.
Well, it would have, but we don't like to play that game. So the whole point of this is to buy the time that you need. If you could have bought back in 2007, 15 years, we didn't know how long, but 15 years certainly seemed to work. Looking back on it, the whole point is to buy time. And how do you do that? Well, you have to carve something off. And as we've said, the critics have said, well, gosh, then you're going to be missing out on what if you have some huge gains, over the first, you're carving off a portion that's not going to be gaining anything. It's going to be sitting in something earning quite a bit less. Well, that's true. But most retirees will tell you that their fear of losing is a lot worse than their fear of missing out on potential huge gains, because running out of money is their biggest concern. And that's really why we talk about this. It's enough to buy time, and that's exactly why we do this. So if you don't have to worry about the first 5 years of retirement, that tends to make you, it tends to make you a little bit more relaxed, but it also tends to make you a better investor because you don't panic, would you say, with your portfolio. It can help take the emotion out of it.
Oh, that's one of the most important parts of this is take the stress, take the emotion, take your greed and fear factor out of it. Understand what you're accomplishing, what you're going to. So I was just looking at the numbers, and if you start at the beginning of 2007 through today, I'm working too quick to get it to the end of 2022. The market's up 360%. 360%. That's still pretty good since 2007.
360% since, what was that, from the beginning of 2007?
Yeah, beginning of 2007.
So what is that?
The high point was somewhere in the middle of 2007. I can't remember exactly. And then we went through 2007 was pretty flat. 2008 was really bad. Beginning of 2009 got worse. And then we hit the bottom and we started recovering after that. But if you held on long enough, not only did you get a reasonable rate of return, you got a pretty damn nice rate of return.
It's not bad. Now that's more than 15. What is that now? 07?
Almost 18.
18 years, and that's through, let's say, the middle or the third, through about the third quarter of 2025. I guess things could change by the time this podcast goes out, but I don't think so. Well, 360%. I mean, that's not bad. I mean,
no. That's right before one of the biggest crashes we've ever seen.
Yes, that includes the downturn.
Oh yeah, it includes the 2008-9 crash. It includes COVID. It includes 2022. It includes, pick your poison of the last, 17, 18 years. There have been some downturns here and there.
Yeah, and that's exactly why we talk about buying time. I'm not saying we're going to get 360% over the next 18 years. We don't know what it's going to be. But I think, again, most people don't care so much about that. Once they're retired, the rate of return is less important than the actual return of my money, as in I need it to be there when I need it to be there. And that's really why we do these
but you
exercises.
Have to give the market time. And that's why you have to build your buckets. Now, when you're working, you are your own bucket number one. You are the asset that's providing your income for the next X number of years. You're working. You got 10 years left. You're the bucket number one. You don't need it necessarily. You need an emergency fund for things that pop up out of the blue that you can't fathom, but that happen. But you've got to give stocks time. Now, you could be lucky and it could go up tomorrow or not.
Well, I could go to Las Vegas and throw it all down on, one
and
number.
You could hit just the right number as you walk by.
Heck
What are the odds of that?
Well, 1 in 36 or 38 or whatever it happens to be. No, it's probably not going to happen, and we don't like gambling. If you want to know more about this stuff, we mentioned the guide that we have that you can download. A lot of this is explained. You can see this really fascinating chart that's in the retirement guide. If you go to luciacap.com, LUCIACAP.com, type in a retirement guide in the search bar in the upper right. It should be the first thing that comes up. You can download it for free and read it. I would highly suggest that you do that, simply because we talk about this idea of sequence of returns and tie it into buckets. We try to do this maybe twice a year just to remind you. But to see it, I think, represented visually is a big help, because it really gives you the reasons why we do this. We can sit here and tell you about it all we want, but to actually see it in action and the destructive effects of a negative sequence of returns and reverse dollar cost averaging, I think it's really helpful to take a look at that. Rick, you and your clients do this kind of stuff all the time, do you not?
Well, we do this for our clients every day.
I'd say it's one of your specialties. That's right. You want to talk to Professor Rick Plum or any of the Lucia Capital Group advisors. Bucket Strategies, been doing it for a long time. 800-644-1150. The number at Lucia Capital Group, 800-644-1150. I mentioned the website, again, luciacap.com, where you can find not just those guides to download, but we have a lot of videos and blog posts and all that kind of stuff. And other guides as well. If you're interested in estate planning, you can type in estate planning, and you can download that guide for free. We've got retirement planning, we got buckets, we got all that stuff, and a Social Security guide as well. Just go to luciacap.com. Don't forget to subscribe. I will remind you yet again, for the 50,000th time in a row, please subscribe to this podcast, because you'll learn a lot. I really do believe that. Go to Apple Podcasts or Spotify, subscribe, and get it downloaded every single week. Do not miss a week. Hey, we don't miss a week. You shouldn't miss a week, right? I would say so. We are out of time. Professor Plum, I thank you so much. I really do. Your knowledge of buckets seems to increase somehow with the passing years. But I appreciate you being here.
You got to learn something new every day, right?
That's right. Exactly. Thank you very much. That's it. That's all the time we have for this week. For Professor Rick Plum, certified financial planner professional and accredited wealth management advisor. Podcast host Johnny Dean, managing your financial future. Thanks for listening. Talk to you all again next week. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. This material should not be considered a solicitation of an offer to sell or buy any specific security or offering. Investors should consult a financial professional to determine whether risks associated with an investment in the shares are compatible with their investment objectives. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. No stock investment strategy or risk management technique can guarantee return or eliminate risk in all market environments. 401k benefits may be subject to change at your employer, the governing pension, or benefit organization's discretion. Content in this material is for general information only and not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. Examples cited are hypothetical or for illustrative purposes only, are not guaranteed and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. There is no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. All indices are unmanaged and may not be invested into directly. S&P 500 index is an unmanaged index. It includes a representative sample of large cap U.S. companies and leading industries. An investment may not be made directly in an index. Bonds are subject to market and interest rate risk if sold prior to maturity. Bond values will decline as interest rates rise. Bonds are subject to availability, change in price, call features, and credit risk. Stock investing includes risks, including fluctuating prices and loss of principal. Target date funds are subject to the volatility of the financial markets, including equity and fixed income investments in the U.S. and abroad, and may be subject to risks associated with investing in high yield, small cap, and commodity related foreign securities. Principal invested is not guaranteed at any time, including at or after target dates. Before investing, carefully consider a target date fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus, which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. Any other individual or company mentioned in this podcast are not affiliated with or endorsed by Lucia Capital Group or LPL Financial.